Zero rating of international services. In today's interconnected world, businesses routinely provide services across borders. But what happens when the business supplying the services is GST registered? In this video, we will share the GST rules on international services. When a service is zero rated, you charge GST at 0% instead of the standard rate of 9%. It's still a taxable supply, but the rate is at 0%. You can still claim input tax credits on your business expenses, subject to the conditions for input tax claims, as the expenses are used to make taxable supplies. Let's clear up the most important misunderstanding first. Not all services provided to overseas customers can be zero-rated. Section 21(3) of the GST Act defines exactly which services qualify for zero rating and the conditions that you need to satisfy in order to zero-rate the supply. International services are organized into several distinct industry categories. Sections 21(3)(a), (b), (c), and (j) cover services relating to international transport and arrangement services that facilitate international movement of goods and passengers. Sections 21(3)(g) and (h) cover services performed on goods for export and prescribed financial services supplied in connection with goods for export or out-of-scope supplies of goods. General provisions under Sections 21(3)(e), (f), (j), and (k) apply to businesses across multiple industries that provide services encompassing overseas land, buildings, or goods, and services to overseas persons. Cultural, artistic, sporting, educational, entertainment, exhibition or convention, and related supplementary services performed completely overseas are covered under Section 21(3)(i). Maritime and aviation services, including vessel and aircraft handling, cargo handling, pilotage, salvage, towage, surveying, classification, supply, leasing, maintenance, repair and parts provision, may be zero-rated under Sections 21(3)(l), (m), (n), (o), (p), and (x). Telecommunication services, trust services, server co-location services, electronic systems, advertising services before 1 January 2022, air and sea containers, and services on goods stored under the Specialized Warehouse Scheme are governed by Sections 21(3)(q) to (w) and (y). This systematic classification enables businesses to quickly identify the relevant provisions under Section 21(3) for their service sector. Each provision under Section 21(3) sets out specific conditions that must be satisfied to qualify for zero rating. Certain provisions within Section 21(3) contain commonly referenced phrases that businesses must evaluate when determining if their services qualify for zero rating. This translates to three core concepts, which are under a contract, directly benefit, and directly in connection. The first concept, under a contract, applies to Sections 21(3)(j), (k), (s), and (y) of the GST Act. This concept requires you to establish whether a contractual relationship exists with your customer. The contract might take various forms: a comprehensive service level agreement, a simple service requisition order, or even email exchanges that clearly outline the business arrangement between you and your customer. This determination is purely factual and will help you answer the question: did you enter into a contract with your customer? The second concept, directly benefit, applies to Sections 21(3)(j), (k), (s), and (y) of the GST Act. This concept requires businesses to identify who benefits from your services. Begin by examining the contract terms. If the contract explicitly states the service recipients, stated recipients are generally considered as the direct beneficiaries. You must also assess whether there are any persons who use, receive, or otherwise benefit from your services from the start to the completion of your service performance. Where provisions under Section 21(3) require that services be contractually made with or directly benefit an overseas person, businesses must also assess their customers' belonging status. If your customer is an individual, your customer belongs in Singapore if their usual place of residence is in Singapore during the period of service. Residential addresses typically indicate this. Individuals with multiple residences may belong overseas if they are absent from Singapore for at least one continuous year while maintaining a fixed overseas residence for employment purposes. If your customer is a business, your customer belongs in Singapore if they have a business establishment or fixed establishment in Singapore and nowhere else, are legally constituted in Singapore with no overseas business or fixed establishments, or have establishments in multiple countries, but the contracted services are most directly used or to be used at the Singapore establishment. You can determine belonging status of your customer through 4 administrative approaches. 1. Direct verification with your customer. 2. Obtaining written declarations confirming they have no Singapore presence. 3. Checking ACRA's business portal for incorporation status. Or 4. Examining customer materials like letterheads and websites for Singapore addresses. When in doubt, standard rate your supplies unless the customer proves they belong outside Singapore. The third concept, directly in connection, or DIC for short, applies when your services are tied to specific goods or land. You need to meet 2 conditions. The goods or property must actually exist when you do the work, and your services must be clearly linked to the goods or property. Your services are considered linked to the goods or property when your service involves physical work done on the goods or land, physical contact or interaction with the goods or land, establishes the physical attributes of the goods or land, affects or protects the nature or value of the goods or land, or affects any interest in or right over goods or land. When your services are mixed, either connected to goods or land in both Singapore and overseas, or benefiting both local and overseas persons, you may apportion the supply value instead of treating everything as standard rated. Separate your supply into standard rated components related to Singapore goods or land, or local non-GST registered beneficiaries, and qualifying zero-rated components by using a reasonable proxy that reflects the actual split, such as market prices for each component, costs incurred for each portion, time spent on each component, and revenue generated from each part. Keep detailed records explaining your chosen proxy and all relevant transactions to support your calculations. To better understand how these principles apply in practice, let's examine the following case. Prime Pipes Limited, a Norwegian company with no presence in Singapore, bought pipes from Singapore for export to their customer in Japan. To ensure the pipes meet their customer's specifications, Prime Pipes engaged Checkforce Private Limited, a Singapore firm, to perform an independent inspection and generate a report on their findings prior to shipment. Prime Pipes can provide the complete set of export documents as evidence that the pipes are exported to Japan. Can Checkforce Zero rate the supply of inspection services to Prime Pipes? In analyzing if zero rating applies, we need to select the appropriate subsection under Section 21(3). For services provided to goods for export and goods transported outside Singapore, Checkforce considers whether their services qualify for zero rating under Sections 21(3)(g) or 21(3)(h). As this scenario involves physical work on goods meant for export, Section 21(3)(g) would be a better fit, as it specifically addresses services supplied directly in connection with goods for export. Let's look at the conditions for zero rating to apply. Are the services supplied directly in connection with goods for export and to an overseas customer at the time they are performed? Establishing the physical attributes of the pipes to meet Prime Pipe specifications is a service directly connected to the goods, and the pipes will be exported to Japan. Checkforce supplied the inspection services to Prime Pipes, an overseas company with no establishment in Singapore at the time the services are performed. The first condition is satisfied. The goods will be exported to Japan, and this intention was communicated to Checkforce when they were first engaged by Prime Pipes. Next, Prime has provided Checkforce with the complete export documents to prove the export of goods. The inspection services also do not include media sales. Checkforce's services qualify for zero rating under Section 21(3)(g), provided the required export documents and written confirmation are obtained within 60 days of completing the services. Let's examine another scenario, this time on services supplied to overseas persons that are not related to goods. Security Limited is a security analytics software company incorporated overseas with no business or fixed establishment in Singapore. To expand into the Southeast Asian market, Security engaged Cyberside Private Limited, a Singapore-based tech company specializing in software licensing and hardware solutions. Under their service agreement, Cyberside performs two distinct functions. For pre-sale services, Cyberside acts as Security's regional marketing team, conducting product demonstrations, handling technical inquiries, and preparing quotations for potential clients. For post-sales services, Cyberside provides comprehensive support services including on-site hardware installations, system maintenance, and technical troubleshooting for Security's customer base. Can Cyberside zero rate the services it provides to Security? Cyberside could potentially consider two different zero rating provisions under Section 21(3)(j and Section 21(3)(k), which involve services provided to overseas persons. But their services do not qualify under the prescribed list of services, leaving subsection J as the applicable provision for services that are supplied to overseas persons. Cyberside would need to evaluate each service component against the zero rating conditions. Let's evaluate the pre-sale services against Section 21(3)(j. First, are the services supplied under a contract with an overseas person? Here, Cyberside contracts directly with Security, which is incorporated overseas with no Singapore establishment. This condition is satisfied. Second, do the pre-sale services directly benefit an overseas person outside of Singapore when the services are performed, or a GST-registered person in Singapore? Here, the direct beneficiary is Security. It engaged Cyberside to generate leads and promote its products. Any benefit to potential customers from demonstrations or technical information is merely incidental. Next, are the services directly connected to goods or land in Singapore? Any hardware used for product demonstrations is merely a presentation tool, akin to audio-visual equipment for a seminar. The services are not performed on the goods themselves. This condition is satisfied. Finally, no media sales are involved in these marketing and demonstration activities. Cyberside's pre-sale services qualify for zero rating under Section 21(3)(j). Next, let's examine the post-sales services. Conditions 1 and 4 are satisfied for the same reasons as before. However, the post-sales support directly benefits Security's customers, including GST-registered and non-GST-registered entities in Singapore, as well as overseas clients, as on-site hardware installation is considered physical work that changes or affects goods located in Singapore. This service is directly in connection to goods located in Singapore. Given this mixed treatment, Cyberside should apportion its post-sales services using a reasonable method, such as time spent, resources used, or contractual value. Overall, the pre-sales component qualifies for zero rating, while the portion of the post-sales services relating to installation requires standard rating. Remember to follow this systematic approach. Check if your services qualify as international services under Section 21(3) of the GST Act. Then identify the specific provision that applies. Next, determine whether you meet the conditions under the relevant provision. Focus on the three core principles. Did you enter into a contract with a customer? Who directly benefits? And whether the services are directly connected with goods or land. If your services include both standard rated and zero rated elements, apply a reasonable apportionment method and keep proper documentation to support your GST treatment. This approach helps you apply GST correctly to international services. For more information, refer to the IRAS website and the relevant e-tax guides applicable to the nature of your services. Thank you for watching.